Good afternoon, everyone, and welcome to today's Lunch and Learn at Innosphere, and a special virtual welcome to those of us joining on Zoom. Today, we have the privilege of hearing from Matthew Meyer, who is the Chief Business Advisor for Life Sciences at Wilson Sonsini Goodrich & Rosati, a firm that Innosphere has partnership with. Matthew leads Wilson Sonsini's Life Science Business Advisory practice, providing strategic guidance to startups and emerging companies across biopharma, medtech, and precision medicine. Over his career, he's held leadership roles at companies like Pfizer, Novartis, and CareDx, and he played a key role in the growth and acquisition of Counsyl by Myriad Genetics. Today, Matthew will walk us through how life science startups can navigate the venture capital landscape, covering everything from understanding investors, preparing outreach, building a compelling pitch deck, and approaching the partnership process with confidence. With that, please join me in welcoming Matthew Meyer.
Thanks so much for that warm introduction. It's great to be here. I want this to be interactive today because it's no fun just to hear one person go on for an hour. So what I'm going to do is walk you through some slides that speak to the various topics that we mentioned at the outset. But really, this is your time. Whether you're a first-time entrepreneur or you're a successful multi-time entrepreneur, the hope here is that some of the content that we're providing today will catalyze interest and provide some context and additional insights to help your venture be more successful. So first, I want to thank again the opportunity we have here to present. Wilson Sonsini, just a little bit on the firm, is a Silicon Valley-based law firm. So we started in 1961, advising companies like Apple Computer and Google, and we have the privilege of now having an office in Boulder, Colorado. So we opened our office there 3 years ago. And really our focus is life science and tech companies. So we love to work with entrepreneurs and innovators at the earliest stage of their company with a view to really helping them grow and be successful as they get bigger. So with me today, we won't be presenting, but I just want to introduce my corporate partner who's based in Boulder, Brent Bassett, who's just over here. So Brent is planning to give a similar workshop in the fall talking about corporate legal best practices. And I think many of you have probably met my other colleague, Bill Barrett, who's our patent partner, also based in Boulder, who gave a workshop earlier this spring. So together, the hope is that you can think of Wilson Sonsini as a firm that can support your legal needs. And I'm coming at it a little bit differently because I am a lawyer, but I've actually spent most of my career, as you heard, on the business side. So the goal here is to sort of impart you with some wisdom today, some insights that'll be helpful when you're trying to raise money and go after investors. So here's the agenda today. Talk a little bit about what we do, which I've already touched on. Talking about the pitch deck and how really when we think about putting together a pitch deck, we think about telling a really good story. Why? Because all of you in this room, when you hear a good story, you remember it. It differentiates, again, off what you hear in your busy daily lives. And investors are no different. So that's going to be a key theme that we're going to talk about. Next, we'll talk about what are the components of developing a compelling investor pitch. There is a bit of a formula. There's alchemy to it, but I think there's a key amount of information that you need to have in the right pitch deck. So we'll go through what that looks like. We'll talk about the current private financing market. I don't think I need to remind anyone how challenging it is out there. We're really in a proverbial perfect storm today. So we'll talk a little bit about some of the data that we're seeing, and also talk a little bit about what are some of the best practices that you can look to do, notwithstanding the challenging financing market. There may be some levers that you can pull on to help get through this difficult time if you're running a company or part of a company. So a little bit about where we plug in. As I said, I run the business advisory practice. It's right up here. But Wilson Sonsini really is a full-service law firm. So the point of this slide is just to highlight that we can help you, whether you're trying to file a patent to protect your idea, whether you're going to sell your company and you need M&A support, whether you need advice on regulatory strategy. The firm is here to help and can provide a range of support to do that. And our business advisory practice specifically plugs in and helps companies in forming areas. We help with fundraising. We can help with partnering. So if you're looking to hitch your wagon to a bigger company, an industry partner, which is often the case, we have a process to help do that, really expand the reach and get in front of some of those big industry players. We can also help with deal comparable analysis. A lot of times when you're negotiating either a valuation for your company or you're talking about a partnership, you want to have information, insights. What are the deals in your specific sector that are going to be relevant? A lot of that stuff is publicly available, but some of it is not. So we actually have access to proprietary databases that can help give you that information. And then lastly, just provide you with general strategic business counsel. So that's what we do. So let's talk about the pitch. So let me start with a couple questions here. How many of you have raised capital, raised money for your venture so far? Show of hands. And I know there are people on the Zoom here, so sorry we don't know what you're doing. But in the room here, just a handful of folks put their hands up. Let me ask the next question. How many of you are planning to, with your venture or your envisioned venture, to raise money in the next, let's say, 12 months? All right, good. So probably at least half of you. Great. Well, then I hope this will be relevant and interesting. And for those of you that are just here to learn, I think this is great because, by the way, I think what we're trying to do here is relevant for anything, whether you're trying to get a new job, whether you're trying to put together a thesis proposal to get research funding. A lot of the elements of what we're going to share, I think, are going to be applicable to other situations. So I mentioned at the start, when we think about putting together a pitch deck, we think about telling a story. And just like a memorable book, a pitch deck that has to have a lot of the same components of a story. So the way we sort of think about this is to structure your pitch deck the way an author thinks about putting together a story. So you start with your theme. In this case, what is your company's mission or purpose? Why did you decide, if you're a founder, to start the company? Why, if you're part of a company that's already been in existence, why did you get involved? Like, what is it about the company? And this is so important because remember, when you're going to venture investors, they see dozens, if not more, decks every month. And if you don't have a really strong connection in with that investor, it's okay, but you have to figure out another way to be memorable. And of course, it's about the science, it's about the technology. We'll talk about those elements. But if you're not talking about it in a really compelling way, a lot of times investors will just gloss over it. It's just not going to be interesting for them, and that's just human nature because people are busy. So that's why we really emphasize the storytelling element. The next part of it is your characters. In this case, what's your product, your platform, the service, and the team that you bring to the table. As you know, just in a great story where the characters make it interesting and you build up a character and then you can identify with them, oftentimes really talking about your team and their experience. Like what was unique about different team members? How are they well placed to be successful here? Was there something in their past that drove them to get involved with this company? Try to link that back to what your story is because it's going to be memorable. The plot is your development iteration in commercialization. How are you going to go from your scientific theory, if that's where you are, to the marketplace? I was talking to one of our clients here, Chris Buchanan from Red Drop DX, and he was saying, well, we're focused on building, selling, and raising money, and that's what you have to do, right, to be a successful entrepreneur. And in this case, that's really what the plot is. How do you take your product from X to Y, get it to the market? Because ultimately, just like in a story, the reader wants to be entertained. In the case of an investor, they want to remember your story, but what do they care about more than anything? Return, exactly. Making money. So that's what you have to your plot has to lead to that. That's the end. That's sort of the climax of your story in this context. The setting is the market. Where's your market? Are you building a market? Is there a market that already exists? Maybe it's a little bit of both. How do you get into that market and make it successful for you? Conflict and tension. There are going to be objections. I always say a good pitch is one where you actually get a lot of conversation going with the investor, because it shows they're interested. If you're just up there for 20 minutes pitching to a bunch of investors and there's no questions, probably not a good sign, because they may just not be interested. So when you get people asking questions and even challenging you, think about it just like in a story. There's conflict and tension, and your goal is to resolve it. You may not have all the answers. That's part of business. Nobody has all the answers to all the questions. But you want to at least engage and have a good discussion about how you would plan to handle certain objections. And then lastly, perspective. Why your offering has superior product market fit and differentiation. You want to be talking about that, because ultimately that's going back to why are investors coming into your company? Because they want to make money, the ROI. So you need to be able to provide that perspective. So let's get into some of the specifics. So you kind of get the sense now, this storytelling aspect is very important to developing a winning pitch deck. But there are really three main buckets that are going to be important here to put this all together. The first is putting together focused and compelling content. And again, seems basic, but in our business, we also see dozens of pitch decks every month. And the challenge is if you have a pitch deck that isn't compelling and isn't succinct and doesn't get to the point, unlike a novel where you might have tolerance to read 50 pages before you really know what's going on, like a James Michener novel. And the difference here is in a pitch deck, you gotta make it interesting, but you have to get to the point quickly. So that's where it's important really to be focused and making sure the content is compelling. The second thing is know your audience, pitching to the right investor audience. So we'll talk more about this in a couple of slides, but the main point here is not all investors are created equally. Some might be very scientifically focused, others might be more financially focused. So I'm not suggesting that you build a bespoke deck for a range of audiences per se, but you need to sort of anticipate what your audience propensity is. Are they going to be more financially focused, more scientifically focused? And perhaps you vary some of the slides. For example, if you're going to, the people looking at the deck are really not interested in the science, at least not in the first pass. So maybe you take some of those heavy science slides and put them in the backup. And you really just focus on what's the unmet need. Talk a little bit about the science. You can't gloss over it too much, but you need to be thoughtful about, playing to your audience, because otherwise people aren't going to engage. And then lastly, confident and effective execution. So remember, the deck is really designed to get you to first base, meaning getting that conversation with investors. The standard approach is send me your deck. If you're a prospective investor you're talking to, they say, okay, I got a new co, it's doing something in biotech. Send me your deck. The deck is designed to really engage and get someone excited. And then once you get to the first base, that's when you have the conversation. You actually pitch in real time. So that's where you really want to practice. So you have to be confident. You need to make sure that your story is tight, and that's going to really reflect well, and it's going to get investors confident in what you're doing. So in terms of the content, let's talk about what do we typically like to see in a deck. And I'll caveat this by saying there is no perfect formula, as I said, but in our experience, these elements up here tend to be what we like to see in a deck. So first, start with the company mission. As we already mentioned, it's important that you start with why. Like, why does this matter to me? Why did I get involved with this company? Why did I start this company? And again, the key to that is you have to be memorable. So if you have a personal connection, let's say to a medical product that you're building, talk about it, because authenticity is one of the most important things that investors are looking for, because they know if you're driven by something that you experienced in your life or one of your loved ones or friends encountered, it's going to drive the passion. And ultimately, investors want folks who are passionate, because the reality is many of your business models are going to change. If you're early, what you think might be the product could change, what you think might be the market may evolve. So the point of that is investors know that. So they really are looking for people who are driven, hardworking, because they want someone who has the resiliency and the passion to potentially pivot. The next on the right is related to that, the team in the background. As we mentioned before, just like characters in a good story, You want to talk about your team, explain how their backgrounds are relevant. And by the way, if you say to me, well, gee, Matt, that sounds great, but I'm a postdoc from, CSU. I haven't started a company before. Totally fine, but there's got to be something in your past that makes, your background relevant to what you're doing. So don't be afraid to talk about it, even if it's slightly tangential to the business at hand today. Next, the unmet need. How many times have we seen opportunities where you have a product or a service that doesn't necessarily address an unmet need? So you always want to start with that problem statement. I'm building this company because this market doesn't exist, or it's underserved, or whatever it is. Again, it's part of like that storytelling. Get people excited to want to engage. When they understand that there's a problem, then they're going to be more interested in focusing on, what do you have? I want to learn about this, the plan you have to address the problem. Which brings us to the product market fit. So in this case, talk about your product and how does it fit into the market? How is it addressing the unmet need that you've spoken about? The market opportunity, for many of you, this is pretty straightforward. You just need to basically get an investor comfortable that if you can develop a product to address a certain unmet need, there's a big enough market there that they're going to make money. So some people say, well, do I need to have like $1 billion market opportunity? No, not necessarily. It depends on how much capital you need to put into your product. But you might have a market opportunity that's a tenth of that, and that's fine. Maybe you say, I only need $2.5 million, and I think I can get into the market and then take a meaningful market share. Remember, investors are looking at this from the calculus of ROI. I put X dollars in, I'm looking to get Y dollars out. And as you know, the typical formula is 10X. Why? Because they know many of their investments, unfortunately, won't make any money. So they're looking for 10X returns. So you just have to kind of keep this in mind, and this is another thing I really like to emphasize. Put yourself in the mindset of an investor, and how is, what you're saying going to get them more excited about saying this is going to generate a 10X return if things work out. Competitive landscape is part of that. You need to know your market. You need to be thoughtful about articulating how you're going to play, against the competition. Intellectual property, I'm sure by now you all know how critical this is for many of you. If you're a services business or a software business, maybe not as critical, but you always want to be thinking about how can you protect your business model, because most investors are going to get there. Once they get comfortable with the business opportunity, they're now going to say, okay, is it protectable? So if you're developing a pharmaceutical compound that's brand new, should be protectable. But some of you might be developing businesses that, compound products rather, that are not completely straight down the middle of the fairway. So that's where talking to a good IP person can really help you understand that. And you want to do that early, as you probably heard, for those of you who have heard our colleagues speak about IP. Why? Because in this country, it's first to invent in the patent office. First to file. So actually, you might have a great idea, but if someone else gets wind of it and they file before you, even though you may have invented that specific concept or product before, you unfortunately may not be protected. So it's very important to really think about that before you're actually doing this, getting in front of investors or any kind of public disclosure for that matter. The next is the business model. So again, that's simple. How does my widget make money? And what's my profit margin? So I'm sure you guys have learned a lot about that, so I need to emphasize it. Development, plan, and use of proceeds. So let me double click on this one for a minute. So a lot of times you have investor pitches where somebody comes in and says, I'm looking for X million dollars, and I have this product, but they fail to really explain this money will be used for these purposes, and it will get me to these value inflection points, meaning it'll get me this much further so that you, Mr. or Mrs. Investor, will have a valuation inflection or increase. Because remember, most VCs know that it could be a long haul. It might take 5, even 10 years to hit a liquidity event, i.e. to sell your company. But what they're looking to do is they're looking to put money to work today that gives them some level of confidence that in the interim, before the company is sold, there is a step up in valuation. So bringing it back to the use of proceeds, you want to make sure that you can say, okay, I need $5 million, for example, now. It's going to get my product into the clinic, or it's going to get me proof of concept. Whatever it is, it just needs to show you're bridging you're getting somewhere of increased value. Otherwise, investors might say, oh, it's interesting, but it's not gonna, I have to report to my investors, my limited partners. And if I can't show in, let's say, 2 years that initial investment is gonna get me there by increasing the valuation, a lot of them will say, I can't do it. And then lastly, the financials, exit opportunity, and deal comps. So a lot of times, as I said, investors, they're starting with the end in mind. Just like a reader might say, well, you know, what's this, how's this plot gonna play out? Well, for investors, the happy ending, as you guys know, is making money by selling the company, taking it public, and selling the shares. So in the same way, you want to be able to point to exit examples. If you're in an industry where there's been exits, and not all are like that, but if you have that, tout it. If there have been great examples, say, you know, look, in my industry, there have been 3 sales in the past 10 years of, you know, nice returns. You want to talk about that. You also want to talk about, you know, what do you think is like a realistic timing to sell? Most investors don't necessarily want you to be focusing on the end game because they want you to really focus on building the company. But of course, they know that the end game is important to everyone. So just keep that in mind as you kind of wrap up your presentation. And as I said, this is a guide. Everyone's style is going to be a little bit different. Everyone's business is a little bit different. So some of this can be adjusted as it best fits your story. So the next thing is talking to investors. And as we mentioned it before, not all investors are created equally. So in this case, you really want to start with understanding who are you talking to, right? You know, there's the classical institutional venture capitalists. You have strategic corporate venture firms that are part of companies. You have family offices. You have angels. So we could spend an entire session just talking about all the permutations of different investor types and what that means. But really the point is to sort of be thoughtful about who you're pitching to. And again, in this case, you might think about having 2 different decks, one for a institutional venture capitalist and one for, let's say, a family office. Why? Because their hurdles on timing to make money to get out of the investment might vary. 80% of the deck is probably going to be the same, but you want to just be thoughtful about that, because if you're not talking their language, that specific investor type, you may be missing an opportunity, and they're going to say, well, gee, you know, Matt, you're talking, it sounds like you're really focusing on like the venture community, and we're a family office, and we don't care about like a short-term exit. We're really mission-driven because our family office cares about, you know, whatever, oncology, whatever it is. You just want to be thoughtful about that. The next thing is, what's the strategy, right? So make sure that you know what an individual investor is looking for. So for example, what's the development stage? How much money do they put to work? How much of the equity do they want? This is a lot of work, right? Because you're thinking, wow, you know, somebody already told me I have to go out to 100 investors. Now you're telling me you have to kind of know all this. Well, yes and no. You know, I don't think you have to know all this to a exactly precise degree for each investor. But the point is, you want to avoid situations where you're going out to an investor that's clearly not a good fit. You know, you're going out to an investor that says, I love your product idea, Matt, but I only write checks of $50 million or more, and you're asking for $5 million. Well, maybe they like your idea, but it's not going to help you today. Maybe you see a relationship in the future if you end up needing that kind of money to raise. But the point is, you want to be really efficient here, because it's hard enough getting investors to bite. As I'm sure you've heard from other folks at Innisphere, you know, I'd say probably for every 100 investment opportunities that a VC looks at, they probably take meetings with 5 of those 100, and maybe they invest in 1. You know, this is sort of general rule of thumb. It's going to vary. So the point is, you want to just be really targeted and be thoughtful, because they're already going to be looking at this, your opportunity with a high screen. So try to make it as, you know, relevant to them as possible. Background and interest, we talked a little bit about this before. The main thing here is to try to make a connection. Like, you know, understand who your audience is. Is it scientific? Is it a financial person? Something else? Because you can sort of connect with them. And of course, with LinkedIn, you can pretty much figure this out once you know the names of the people at the funds. And then the fund history. This is an important one, because as many of you know, venture firms typically have a 10-year shelf life. So if you're talking to a fund, for example, that might be in the 7th or 8th year of its 10-year fund life, they may still have a little bit of dry powder, meaning investable capital, maybe not, but if they do, and let's say they want to invest in you, what will be the concern? Waste of time. Yes, exactly, because what happens if 2 years later, they're at 10 years, and their limited partners are saying, hey, okay, where's my check? And all of a sudden, they put in $5 million into your NewCo, and you said, I can't exit, I'm just building the company, right? I'm still doing clinical testing, but they're looking to push for an M&A deal. You don't necessarily want that outcome, because it's not gonna be consistent with your aspirations as a founder to build a company. So you just wanna think about that ahead of time. Again, this is maybe a little bit later on once you get into conversation, but again, some people say, oh, it's a nice problem to have. True, but it could still be a big problem, if it played out the way we discussed it. And then last but not least is a network, and obviously being part of Innisphere, for those of you who are, is great. That's a wonderful network. But all things considered, the more warm connections you can make to the VCs, the better. Why? Because chances of getting a meeting are gonna increase, and even if it isn't the right fit for them, you'll get feedback. And in this process, it's so important just to iterate, to hear what people are saying. And a lot of times VCs won't tell you that. They'll just turn down an opportunity. Why? They don't have the time and they don't want to get into it because they just have to move on. But if you know a VC or there's a VC in your network or, an advisor's network, chances are at least you'll get a little bit of color. And by the way, most of the time, the reasons they say no thanks has very little to do with the merits of your business. It has a lot just to do with the fact that many of them are only going to invest in a handful of companies a year, and they have very specific areas that they want to invest. Question?
Yes, what's your thoughts on those VCs that are willing to lead on investments versus those that are not?
So the question is for those in the remote, what are my thoughts on investors that are willing to lead around versus those who are willing to follow? Right. So I'd say most of the time, in my opinion, you want to focus on getting the lead in. Most of the time in the processes, when you go out, you have a lot of investors who, if they're interested, they may say, oh, this is great, Matt, but we don't lead or we can't lead. You have, we kind of call it the sideline sitters. So in those cases, you want to capture their interest. Say, great, well, does that mean you'd be supportive to come in as part of the syndicate? The syndicate is the rest of the investor group outside of the lead. I think that's point one. Point two is, so getting the lead is the hardest in a process in our experience. But when you get the lead, then you really want to focus in clearly on, do your diligence on that investor. Why? Because they're typically going to set the terms for the financing, and as importantly, they're going to go on the board. Most of the time, if it's a Series A financing, they may say, okay, we're going to take a board seat. So you really want to do your diligence and even talk to, once you're in those later stage conversations, you can diligence that investor, and you can even ask them, can I speak to a couple of the CEOs of companies you've invested in? Why do you want to do this? Because you want to make sure that you're not signing up for a nightmare. Right? Meaning, there are tough investors out there, and of course, your goal is to first get the capital, but second, in my opinion, as importantly, you want to find the right strategic partner for your company. So that would be a key part of vetting the lead. Another question?
Do you have a sense for how many ventures are invested in a year, the total number? Do you have a sense for that? Or
across healthcare?
Yeah, you can use healthcare.
That's a good question. I mean, they're across all venture funding for healthcare. I don't know, Brent, if you have an idea. I mean, it's clearly in the thousands, if not more. I mean, you think about how much venture capital money is floating out there for healthcare companies and how many deals are done. I'm going to say it's in the thousands, but I don't have a specific number for you.
I would think if you set aside services and things like that, I would think this. These days, it's going to be hundreds, I would guess.
You can get it off Crunchbase.
Yeah, so what would be the best source to or sources to pull that together and get a total sort of view of that?
Colorado Bioscience Association, that's a nice, sort of, statistical data.
Okay, thanks.
And Crunchbase does it too, but you gotta be a member.
Yeah, I think those are good. So folks in the audience were suggesting the CBSA, Colorado Bioscience Association, Crunchbase. And there's another one too called PitchBook, which I think is also subscription-based.
Slightly expensive.
Very.
Slightly expensive, yeah. Expansive and expensive. Good. So just moving on here, kind of third piece is confident and effective execution, right? So you built this deck, you've done your research on your audience. Now it's time to, it's showtime. So, you know, how do you nail it? So first, as we talked about, try to customize your pitch to whoever you're presenting to. As I said, you don't have to customize the deck, but when you're talking to folks, if you get that meeting with that VC, do your homework, really try to connect with them, because oftentimes that can make the difference in terms of moving forward. Qualify your audience early, as we talked about, focus on the most interesting aspects of your pitch to them. Maybe in your research, you realize that one of the VCs you're meeting with has a family member who maybe suffered from the disease that you're trying to treat or cure. That's a great connection. So try to make it as personal as you can. Ask questions. So I always like to say that, as I mentioned before, the best presentations and engagements are when there's give and take. Again, if you're just up there for 20 or 30 minutes, there isn't, give and take, then there's not engagement. So I think in addition to fielding the questions that your audience is posing at you and be ready for those tough and challenging questions and don't take offense, use it as an opportunity to engage and learn, because if you get defensive, it's kind of like an interview. You know, the investor's gonna say, oh, this is how this person's reacting? I'm not sure, how are they gonna be in a boardroom when things are tough and I'm not hitting my budget? So just try to be constructive about it. But also, as we kind of were talking about before, you can ask questions of the VC, maybe not on the first go, but you want to learn, how do they work? Like, tell me about how you run a board meeting. Try to get into that aspect of it, because it shows you're thoughtful and you're being picky, and oftentimes that makes investors more interested because they see you're actually a pretty, you're a demanding executive. So that's a good look. Keep it simple. So as we talked about, really focus on, just getting to the point. You have to remember how busy these folks are. You want to capture their attention. Give them a high-level understanding of what you're doing. If there's an interest, as many of you know who have raised money, the process of going from the first pitch to a term sheet, in between that, there can be months of due diligence, where you have a data room, and you have all kinds of questions and answers. So there'll be plenty of time to get them excited, and definitely in your deck, you should have a lot of backup slides on core parts of your science and technology, because hopefully you'll get a good question from somebody saying, oh, tell me about your clinical data. How did that work out? Go to that slide. It's a great opportunity to show up and look really strong in a presentation. And then, as we talked about at the beginning, use the entirety of your pitch deck to tell a memorable story. If there's a personal connection to what you're doing, finish the story, finish the pitch by bringing it back to, this is why I started this company. This is why this is so important. This is why society needs this product or service to make lives better, because that'll keep it memorable.
You bring up a great point about data, and often data is the traction between an idea, something that's actually tangible. So where does the data fit into the story?
Yeah, it's a really good question. So the question was, where do you fit the data into your pitch, your story? And I would say this, if it's critical, if you have data that demonstrates, let's say it's a drug compound, that it's working, even if it's preclinical, you definitely put that into the deck, as long as it's not confidential, as we talked about, with the caveat that you don't want anybody to file something on it from an IP perspective. But if that's protected, then absolutely, you should have one or two killer slides, maybe with the graph, right, showing the separation between your active and placebo, showing, hey, we got a great p-value in this animal model. And by the way, we published it in this peer-reviewed journal article. Trumpet that information for sure, because ultimately that's what these investors are looking for. They're kind of jaded. I mean, you know, I've worked with dozens or hundreds of VCs now, or maybe jaded isn't the word, but they're gonna be skeptical. They're always looking to cut through the noise and get to the so what. And in this case, as you mentioned, the clinical data is for a company in the drug therapeutics area, that is the so what.
But I do think you need to be selective, right? You don't want 20 graphs of individual tests or.
Nobody wants it.
Right, you know, I think especially people that come out of the academic world, they want a lot. And you want the one or two killer experiments, right, that tells your story, but it, you know, doesn't sort of bog them down with like, what do all these lines mean?
Go ahead.
Yeah, I'm intrigued by your emphasis on the personal connection, because coming from the area of science, that's kind of frowned upon. I mean, basically, you're maybe too emotional if you have a family history of it. You're not going to be as stable and steady and pursuing the answer. So I'm surprised that the business world would look at this differently.
Yeah, so the question is, you know, surprised that actually you want to necessarily link personal history, maybe of a health issue, to your narrative. And that's a very valid point. And I think the way to do it is, it has to be authentic, of course, to you, right? You as the founder, the leader of the company, you have to feel comfortable doing that, right? Being vulnerable. But assuming you can get past that, then I think, why I think it's a good thing is because you're turning, you know, maybe a challenge, a crisis in your life through, you know, a family member, or even in some cases, it's the founder themselves that start a company because they've had a disease. And what, you know, you could say, oh, it's destabilizing to the person. I think the way we think about it is turning that into a positive, saying, you know, I've committed my, you know, my journey to developing something because I went through this and this was so challenging, and I want to try to prevent this from happening to others. So a lot of investors that we talk with are mission driven. Mission orientation is important. So if you can work with a founder who has, you know, the science behind them or their team and perhaps has gone through that, we think that can be very catalyzing. But, you know, absolutely, it's not for everyone. That's why I said, you know, there's no absolutes here. It's a stylistic approach. So certainly there can be those who may not be comfortable with that. Is there another question?
I'll wait till.
Okay. So we're through this here. We're in good shape on time. We have about a little bit over 10 minutes, and there'll be time for questions. We just have a few more slides. So this is sort of a checklist of how to think about, you know, how you execute on your delivery. So we talked, this is kind of pulling it all together, but a couple of things really to emphasize here, you know, keep it interesting. So number 3, you mentioned the clinical data, and as Brent said, you want to be careful not to get into too much clinical data either, because sometimes that can just be overwhelming at the first go. So focus on, you know, what are those 2 or 3 slides, for example, if you have data that show how my product is working. Flexibility is very important. So some people will say, how do you handle a situation where you start your presentation and, you know, you have this great slide deck you're going to run through for the next half hour, and 5 minutes into it, you have an investor that, you know, raises their hand and says, Matt, you know, like, tell me about the financial model of the business. And there may be a temptation to say, well, I'm going to cover that. So, you know, can you wait? And that may be perfectly fine, but in our experience, again, as I said, when investors are asking questions and engaging, well, sometimes it can be a little bit out of sync to have to jump to that. It's an opportunity to address their question when it comes up. So in our case, we would suggest maybe engaging with them, saying, well, Joe, you know, interesting question. We're going to talk about it in a few minutes because it's on slide 22. Well, let's go to that real quick. Because if you don't do that, what could happen?
It's interesting.
Exactly, you lose them. You know, they need to say, well, thanks, Matt, but no, I wanted to hear the answer now. I'm focused on it. So that's why we think it's an opportunity. Really know your presentation well. don't get flustered. Practice it with lots of people, practice it with your colleagues, with your family, and have people be those difficult members of the audience to try to fluster you, because, you know, you don't want that to happen. And that's kind of the last one there, just try to be composed on this, and remember, your passion will shine through. You believe in what you're doing, and, you know, challenging questions should be welcome. So let's talk a little bit, we'll go to data now. As I mentioned, I want to share a little bit of information on kind of what we're seeing, which I think most of you are probably familiar with, but, you know, the markets have definitely been in a difficult position when we talk about life sciences, really ever since, you know, the end of COVID, because public money rotated out of life sciences, and then you had interest rates that went up significantly. But over the past, you know, couple of quarters, that's just continued. So this shows the deal count for early stage life science venture capital funding through Q1 of this year, and you can see a significant decrease in the number of deals that are getting done. You see the deal size, this is a macro number, the 10.9 billion. So, you know, it's come down a lot from last year. It's kind of bumping along here. So I think the message really is, you know, it's a tighter market, but there is money out there, but it's not nearly as robust as it was, you know, in the past. And then this gives you a little more granularity in terms of where is early stage VC money going by subsector. So you can sort of make out the different colors here. The biggest segment's going to biopharma, and then digital health actually is second, followed by devices and then care delivery. But I think the main point here is you see a significant drop in the total number of early stage, you know, value deals being done, and, you know, really it's come down significantly over the past couple of quarters. And again, this isn't unfortunately, I think, a surprise to you, because, you know, we see this every day, right, with regard to the markets, with tariffs, with funding cuts, with grants, the NIH, the National Science Foundation. So, you know, it's a tough time, but what we wanted to leave you with is a couple positives, which is great science gets funded. So this is a slide that just highlights kind of some of the stars. I'm sorry for the formatting issue here. I don't know if we can do anything with that, Robbie, but if not, this slide is, you can see that some of these deals, there's some of these companies that are leveraging AI, machine learning, precision medicine efforts, obesity, which remains hot. They're getting really big deals. So, you know, everyone in this room, you know, can do that, you know. The point is there is money out there. It's harder to come by. But just, you know, I think this is important to keep in mind that there are a lot of firms that are looking for great science, and it will continue in spite of the downturns. And then in terms of what you can be doing in spite of the tight capital markets, this slide gives you a sense of, you know, some of the things that many of you probably are doing, and I bet you talk about this often, but just for those who may not be familiar with it, you know, capital efficiency, for those of you who have companies that are running and you have money, you just have to make the money in the bank last longer. So, you know, you have to just tighten the belt, as I'm sure many of you are doing, to ensure that you're padding your cash runway, because it is going to take longer to raise capital. So right now it's a game of survival for many companies, and cash is the most important indicator of survival. The second is non-dilutive funding. While we know that federal funding is definitely under scrutiny and is being cut, sadly, there are non-governmental organizations like the Gates Foundation that continue to fund great science. Michael J. Fox Foundation, for example, for those of you who are maybe doing anything with CNS in the Parkinson's area, are two examples. In California, we have the California Institute for Regenerative Medicine. So you guys who are based in Colorado, obviously, if you're associated with Innosphere, they're probably a great source of opportunities here as well. So you just have to, I think, continue to redouble your efforts to identify creative sources of funding. And then that bridges to strategic partnerships. So those of you who might not have been looking to partner off with a bigger industry player in the past may want to say, can we do that? Is that something that's in bounds? And the reason for that is, you know, a big company is typically looking to partner with innovators and they have resources, they can perhaps help develop your product. You may have to give up some of the upside, but if it's in exchange for getting a company, getting your product or program, into the development stage, whereas it might be sitting today, I think it's worth considering for sure. And then, lastly, for those of you that have teams, everyone reads, the same headlines as you do. So I think it's important just to be transparent, acknowledge this is a tough time, try to, talk about what you're doing to ensure the company will continue. And, for those who are, having equity incentive plans, there are opportunities maybe to offer some incentives by refreshing options at a lower strike price. Give people, reason to want to continue to work through that. Question?
So what would you say is the current sort of timeline for an early stage company? How long does it
take? So the question is, what's the typical timeline today for an early stage financing in life sciences? So again, with the caveat that there is no real typical, I would say you have to give yourself at least a year. At least a year. You may get fortunate and meet those few investors that really want to move quickly, and it could go faster. But as you're seeing, and as the data indicate, even investors that are interested are also moving a little more slowly. Like they're all watching the markets. They're hoping things are going to settle down. So I think a year is absolutely a good rule of thumb for that process. And it can take longer, right? We have situations we've seen where it might take 18 months, and some companies don't even get funded, privately. Just depends. And again, this is not, I don't want to sound bleak, I think you guys are in an amazing innovation field, and the good thing, if you're in healthcare or animal health, there is so much opportunity, and we'll get through this, right? I mean, this is a cyclical industry, and I'm confident we'll come out of it. So, with that, we have a few more minutes for a few more questions.
Based on the last question, do you see opportunities perhaps for these very early stages in the current funding situation, maybe going after angel investors rather than VCs?
So the question is, in this difficult financing market, is there perhaps more opportunity for early stage companies to go after money from angel investors versus the VCs? I would say absolutely. Absolutely. And not only angel investors, but also family offices. Why? Because they're somewhat less driven, not completely, but less driven by the externalities of the public markets. They don't necessarily have the same timelines. One of the reasons why venture firms aren't investing as much is they don't have as much money to invest, because the companies in their portfolios that they expected to get acquired or go public over the past 4 or 5 years may not have because of the external situations. Whereas in angel investors or family offices don't have necessarily that constraint. They still may be invested in companies that haven't gotten public, but their timelines tend to be different. They don't have limited partners to worry about the way a traditional VC firm is.
Yeah, I'm curious, I had a question on market sizing and how you see those in pitch decks. I've struggled with this a lot, where you've got the TAM, SAM, SOM slide, and there's a disproportionate amount of energy you spend on making it believable versus making it attractive, and then using that to maybe formulate some of your business projections. And it's I'm curious as to what your expectations are when you see slides like that, like how scientific versus how subjective is it? Is it table stakes? And what kind of lens do you think when you look at them?
Yeah, good question. So the question for those on the Zoom is, help us understand, like, what's the best practice when it comes to, like, addressable markets, and talking about, the typical slide we see, which you're right, it's the TAM, total addressable market, the SAM, serviceable addressable market, and the SOM, serviceable obtainable market, which is typically a series of concentric or circles that are within each other. So I think a couple things. First, I think you're generally right. I think it's kind of table stakes. You need to have a slide like that needs to be directionally accurate, because if you don't, people just are going to assume, well, we know what the market is. With that being said, in my experience, VCs, they're really focusing on what's your technology, does it work, or what does it take to work, do you need to do clinical studies? And then it's more of a, in my opinion, a little bit more of a qualitative analysis to just get a sense of what's the market out there today? Like, is there a established market for your product? And how, if so, then how does your product differentiate? Or if you're building a new market, then, you know, how would you come into the market? So I think if it's a new product, like you're kind of creating a new market, then I think it's more important to be thoughtful. And one thing that we typically like to see, if you really want to get into this, is do some market research. Who are going to be your customers? You don't have to go out to hundreds necessarily, but get sort of like a directionally good number. Maybe it's a couple of dozen. Interview them, and this day you can do a SurveyMonkey, you can get some data, and basically ask these people, here's the product profile of what you're trying to develop. Would you use it, you know, generally? We find that that is also really helpful, because I think this, the TAM SAM and some is, as you said, it's table stakes, but it's not always compelling. Okay, I think we have time for one more question.
Our product could be applied to either fitness or to a clinical service. We've been primarily looking at fitness first to avoid the clinical trials. We've got a lot of experience in medical device. But I'm a little afraid that by going in with a fitness product, you kind of don't come across as having that future in a more professional environment. And your thoughts on that would be interesting.
Yeah, so the question was, this gentleman has a company that has a product that can be used for sort of fitness sector and also clinical healthcare. And what are the perspectives there to consider where to go? I mean, first of all, you're fortunate you have 2 shots on goal. You have 2 markets, so that's the good thing. And it's clearly cheaper to get the product onto the fitness market. I do agree, though, that I think the bar perhaps to getting a healthcare investor interested could be higher or not. Because here's the opportunity that I see for you. If you can demonstrate that your product works in a fitness context, you know, you kind of check the box. You can say, hey, this is working, and now I'm going to go upstream. You have confidence, and you have to do that clinical study, maybe run it through a 510K process with the FDA. So I don't think it's, I mean, again, we can dig into this, it's hard to sort of talk about it in generalities, but I think, again, in this market, what can you do to move forward quickly? And if it's the fitness product, because it doesn't cost as much to validate, that might be the way to go. All right, well, I see we're out of time, but I want to thank everyone for the great questions, and look forward to staying in touch. If anyone is interested, we can circulate the deck, and thanks for your attention.